Most people believe the money in their bank account belongs to them. You assume the balance on your screen represents a physical storage of value. But the legal reality of the banking system works very differently than most people think. The moment you deposit your cash, it ceases to be your property. Inside the institutional framework, your access to those funds is entirely conditional. The real rules governing your liquidity are rarely explained. Once you understand how this mechanism works, the idea of full ownership of your money starts to look very different. This analysis examines the structural mechanism of the modern banking system and the illusion of digital ownership. We are moving into a period of systemic fragility where the distinction between a deposit and a debt becomes a critical point of failure. This is not about a temporary crisis, but a fundamental institutional architecture designed to protect the system over the individual. It is a long-term shift in how wealth is controlled and accessed within the global monetary order. Imagine looking at your bank app and seeing a number that looks like your life savings. You feel secure. But in the eyes of the law, you are not a customer with a vault. You are an unsecured creditor. When you give your money to a bank, you are effectively providing them with a loan. In exchange, they give you a digital promise. This promise is that you can have it back, provided the system remains solvent. This is the difference between property and a right of credit. One is a physical reality. The other is an institutional promise that can be suspended at any moment. Most people only realize this late, when the system experiences a moment of extreme stress. The mechanism that allows a bank to freeze or restrict access is not an accidental glitch. It is a programmed feature. These are the bail-in clauses that were integrated into the global financial structure after the last major crisis. These rules ensure that institutional power remains intact by using the deposits of individuals to cover the losses of the institution. This creates a massive asymmetry of power between the person who earned the wealth and the system that holds it. The illusion of ownership is maintained by the daily convenience of digital transactions. As long as you can tap your card and buy what you need, you believe you are in control. But the infrastructure underneath that card is a complex web of permissions. Every time you spend, the bank must approve that transaction. This means your ability to participate in the economy is a privilege granted by a third party, not an inherent right of your labor. The hidden reality is that the bank operates like a casino. Your chips only have value as long as the house allows you to stay at the table. We are currently witnessing a slow systemic erosion where the rules of access are tightening. Limits on cash withdrawals, increased scrutiny of transfers, and rising account closures without explanation. These are symptoms of a deeper structural shift. The banking system is no longer just a place to store value. It is an instrument of surveillance and control. As the digital economy expands, the wall between your wealth and your access to it becomes thinner and more opaque. If you want to understand how these hidden financial mechanisms work before they affect you, consider subscribing. Because most people only discover how the system is truly wired after it is already too late. The concept of money has been replaced by digital fiat credit. In the physical world, if you have a gold coin in your pocket, you have a finalized asset. It is nobody else's liability. But in a digital bank account, your wealth is a derivative of the bank's solvency. If the bank fails, or if the central authority decides to restrict the flow of capital, those numbers on your screen remain just that, numbers. They lose their utility because they are not finalized assets. They are contingent claims. This brings us to the core of the risk, the lack of liquidity. Banks operate on a fractional reserve system, a structural reality most people ignore until it is too late. They do not keep your money in a drawer. They lend it out or invest it in long-term debt instruments. If everyone decided to exercise their right of credit at the same time, the illusion would collapse instantly. This is why the system must have the power to freeze accounts, not to punish you, but to prevent the house of cards from falling. The catalyst for a sudden freeze is often hidden in macroeconomic data. High levels of systemic debt and currency erosion pressure banking architecture. When national debt interest exceeds the defense budget, the system becomes desperate for liquidity. Citizens' deposits become the last defense for the institutional elite. The bail-in is not a theory. It is a legally codified tool waiting to be used. True protection requires a shift from digital illusions to physical finality. Diversify into assets with no counterparty risk. Physical precious metals are wealth outside banking server permission. When you hold physical gold or silver, you are the final owner. No institution can click a button to freeze its value or prevent trading. It is an asset with finality. The same logic applies to other self-sovereign wealth. Assets in true auto-custody, physical or decentralized, remove institutional intermediaries. Reducing exposure to the digital banking loop reclaims control. This is not panic, but sober recognition of institutional asymmetry. In a world of digital promises, you truly own only what you physically control. The window for this transition closes slowly, then all at once. Rules are rewritten to favor system survival over individual access. We see it in the push for central bank digital currencies, giving issuers granular control over your credits. The illusion of the bank account is the final stage of a monetary system detached from hard assets. When the next phase of structural stress hits, those who relied solely on digital numbers will find themselves at the mercy of a system. The institutional power will protect itself first. This is the historical pattern of every currency and banking collapse. The realization that the money was never yours comes too late for those who didn't see the mechanism behind the screen. The question remains whether you will continue to operate under the illusion of ownership or seek the clarity of finality. The numbers on the screen are a convenience, but they are not security. Real security is found in assets that do not require an internet connection or a banker's approval. Have you ever experienced a moment where your bank restricted a transaction or questioned your use of your own money without a clear reason?